And we're live. Welcome to another unmissable Sunday show. And Benny's back in LA. Quick rundown of what we're going to do. We're going to just take stock of March. Then we're going to dive a bit deeper into the world of tail hedging in rates, in FX, touch on what's going on in memory, touch on a theme that I wrote about this weekend at the end in terms of the ruggedization of Australia. Benny, how are you?
Fantastic. Happy to be back in LA in my office, organizing stuff. It's been 6 weeks, and can't even believe that I was broadcasting from the war zone a month ago now, mate. I mean, it feels like it's been like a year.
I know. I can't stop thinking about the Captain Haddock meme. What tough week. It's Monday, Captain. Yeah, It's been an interesting month, and to be honest, if you just look at the board, globally, unless you owned a truckload of energy stocks, nothing else worked.
Yeah.
And then if you look at last week, and this is the FinViz sort of ETF weekly performance, where you get bonds and equities and commodities all on one heat map, which I quite like. Basically, it's nice. Energy. Also, it's energy and the inverse ETFs. Gold and gold miners, or precious metal complex, generally came back. Yeah, and Latin America for some reason, but that's a commodity play at the end of the day. But yeah, nowhere to hide, right?
Well, go to the next slide.
Yeah.
If you look at that, where's green? Or no, basically the next one after that. Sorry, we'll come back to this.
We'll come back
so I woke up Friday. Yeah, here we go. So to date, or not to date,
walk through the lines. Walk through the lines first, Benny.
Yeah, let me just talk about this first, and talk about what I'm going to say, and then we'll go through the lines. But basically, since this started, let's say February, you had a situation where the traditional hedges that people use have not worked, right? And you've seen all those lines going down to the right. So, there was a lot of people, yourself and myself included, in the front end of it with the 2-year, expected to go down. A lot of macro shops, rates guys got absolutely torched. I got torched.
They got flattened by the flattener.
There's that. Big flattener, right? Big flattener is pain, basically. And, and remember what a flattener is. A flattener means the long end thinks the short end's too tight. And so it's coming in, basically. And so let's just look at it, because, Friday morning was the first time that I looked at the board and I was like, holy cow, risk is down and my SOFRs are up. Then I looked at gold, and gold was up some. And then I looked on the board when I got to the office on the Bloomberg, and utilities and staples were the only green thing besides energy. So, like you said on the last board, energy's been the only place to hide. So if you look at this, the blue line is the 210, been flattening, but then we got a big steepener to end the week. Then the black is just the S&P, which has gone down. I'm sure most of you guys all know, not sharply, but just getting cut every day for a month, and it's painful to get paper cut to death.
High yield. It means the puts don't work, right?
Correct. And so then you have the high yield, which is my biggest position. It's one of my two biggest positions. Has absolutely worked, and it was working before this too. It had been working for since mid-January, basically. Credit has been working, or short credit, I should say. Sorry. Gold down into the right, piggy bank. You have to think all these countries, central banks, whatever, have bought gold, or just punters in general. But the levered community and the community that actually needs money, that was a piggy bank, big piggy bank. These are all piggy banks, because the S&P and gold and the bond market, I would say that this was liquidation, both of leverage and of people just needing money, right? And when you need money, the dollar goes up, and that's what we've seen. And then, basically traditional hedges don't work because it doesn't matter, because people just need dollars, right? And I think that in the bond market and the gold market, we've seen very disorderly moves, whereas in credit, it's been steady, and in S&P, it's been steady. Now, it's been steady, going one way, but it hasn't been some crazy spike. And then the last one is the line is the green. The green was the staples divided by the SPY, which is relative. And you can see that normally is a defensive play getting dunked on just with bonds. And then it followed the steepener very closely on Friday.
Yeah, I think it's interesting. I mean, just getting back to the broader equity complex. I mean, I mean, you've got the yellow 300-day simple moving average there. It's not a line that I typically look at. Yeah, my 200 line got crossed a while ago. So what are you reading here? I mean, we chatted a little bit before coming on. You know, and you made the correct observation, is that these kind of levels don't get wrecked at the first time of asking.
Yeah,
which I think is,
you know. So basically, it was like, this is what I was thinking. One of my partners and I were talking Friday, right? So I had this big, pretty large size risk reversal on the SMH, and it worked like gold in 2 days from Wednesday to Friday. And we can talk about thinking on that later. But like, point was, it was like, you know, risk reversals, when they work great. When they don't work, you get hit on both sides. And I was looking at the line. I'm like, look, I'm a big 300-day guy. And if you looked at that chart, first run at it in 22, you know, it got defended and bounced. And then the first run last year, Liberation Day, it got defended and bounced. And there was a little bounce, a little chop, whatever you want to say, before then going. So I think that it's one of those lines that it doesn't get through very easily on its first try. And that doesn't mean, again, that it can't, right? Like, you know, this is a bad situation. This is the worst energy shock of my lifetime. And I think Rupert, I think of your lifetime too.
I was 3 years old. I was 3 years old for the first oil shock of the 70s. So I don't think I remember it so well.
And that was a big one. Well, and different too, because the one thing about this one is inventories and stockpiles are much, much higher than they were back then. So I think the hit harder. The transmission mechanism was much faster on that. Right now, we have this cliff coming where everybody's still, like, you guys have like, what? Are we guys down to like 13 days of diesel now? Like 14 days?
We'll talk about that in a second. We'll talk about that in a second.
But you know what I'm saying, though? It's like, you think about inventory, like in commodities, where price action doesn't actually, I have a book on this by a Yale professor. You have to account for inventory when you trade commodities, because it can like lead you into false complacency, essentially. And then when that inventory is gone, you can get incredibly sharp moves, basically, and that's the same as in option expiration, where there's this hedge and then it wears off, and then you can get like totally more true moves. Does that make sense?
Yeah, it makes complete sense. Let's get back to the bonds, right? You know, and you put together this slide, which will contrast with what happened with the outbreak of, well, when Russia invaded Ukraine. You know, ultimately, yeah, as no one knows what inflation or what the economy is going to be looking like in 5 years' time, but you know, five-year forward inflation really collapsed over the course of the last few weeks. You know, well, at least the bond market is saying that we're going to have a growth problem, right?
That's what this says. This says that, and look, again, as somebody who's been getting hit on his rates position, I've had to like lean on some of the things of how the shape's moving, how the five-year swap for inflation is looking. There's things that like can be tells of what, you know, the bond market's actually thinking here. And again, like Rupert said, 5 years from now, no one knows. Shit, we don't even know 5 weeks from now at this point right now. And and maybe there'll be only robots in 5 years. Who knows? But the point is that you're seeing real rates rise, which is painful. Inflation drop as nominals rise. So you see they kind of move together-ish, and then this is a sharp break, basically. And remember, real rates rising is really not a good thing for risk in general.
No, but interesting to contrast it with the with 2022, with February 2022, where the world was in a very different place, right? And you just
I can go on it. It's fine. The idea, because Rupert and I were talking about beforehand, is like what you see there is that black line is the five-year inflation swap. That's rising. So that low in February was the invasion when Ukraine and Russia war started, which I can't believe that's still going on. But you've seen it move up, right? So you're actually seeing reals kind of flat to down. And I think that's the big difference where you see now the whole time it's going down. And my explanation for that is this, is that in 2022, we had 10% plus GDP growth in a lot of countries around the world, especially the United States, which is just an enormous number that the only other time you saw it was post World War II. And so, and you had $2 trillion in repo, and you had everyone had a good amount of savings from checks from the government, from no mortgage, from childcare forbearance, from all these things, from just sitting in their house and not spending money at restaurants and Disney World and blah, blah, blah. And so the economy could take it. You could pass prices on in that environment, right? And then, what we saw rates rip higher because inflation was ripping higher. So I think the difference now is we are in year 5 of this 40%, 50%, 30%, whatever, you want to use as your inflation metric. But like there's been a price step up, and then now we're kind of drifting down because the world's naturally disinflationary because of a lot of reasons that I don't need to lecture into. But so I think it's like 5 years of that, your savings have gotten hit. Unless you were owning stocks, you're in the top end, and we always talk about this K economy, you're kind of feeling it. And you see it in credit, you see it in subprime auto, you see it in a lot of different areas. You're now seeing it in housing. And I think it's much different environment than it was then, basically.
Yeah. I mean, it's you could have argued that we were going to get the inflation shock anyway, right? Because of all of those effects that you just talked about, right? And there just happens to be a coincidence that there was, you had the Russian invasion in Feb 22, right? It was, I remember, being an energy bull, right? Well into any thought that Putin was going to invade Ukraine, right? And then it was the invasion that created that commodity blow off top in the first five and a half months of 2022. But really the war in Ukraine was kind of mood music in the background rather than the actual sort of genesis of the move, and then the knock on into inflation. Interesting. Well, listen, let's talk about FX quickly. Finally we got a bit of a dollar move. With the heat being felt in EM, I know that painfully with my EM local currency fixed income exposure, which I'm kind of married to now through. I've just got to tough it out because I own it via a closed-end fund, and I'm not paying the double tax on NAV discounts on the out. But it's sized where it's not gonna reduce me to tears. But the energy shock on net energy importers within emerging markets is a big problem, right? The big ones being it, to my mind, India, Korea, and we'll talk about Korea in a second because they've got a secondary problem as well.
Yeah, I mean, you look at this board, remember the ones on the bottom that are red, with the exception of the Colombian peso, are all just reversed. So they're down against the dollar also. It's just, this is how Bloomberg did it because that's the traditional way. You just Commonwealth, they like to be first, I guess, you guys. But jokes aside,
you've had 250 years, and we're just not acknowledging it yet. Persia's on 5,000.
The one thing I'd say though, Rupert, if you remember, we started the year off when I was in Colombia, and I was given the case that Colombian was a buy, and peso is the only one on the board that's stronger than the dollar in the last month. Now it's oil. I get it.
It's an energy stock. It's an energy stock, right?
Yeah, I get it.
Right.
I'm just saying, it just kind of backs my view that, like, if you were worried about the Colombian peso.
Yep.
So just quick run. We talked about this. When did we talk about this? We talked about this when we first started talking about the leveraging in, December, January, right? I think
and then again in detail about 3-4 weeks ago. But yes, we the deleveraging narrative has been one we've been on all year.
Yeah, and these are just, remember what this is like, you think about, like, there's a primary beta on markets, and then there's the expansionary beta. So, you have NASDAQ is the more expansionary version versus S&P. Use ARC as like the tertiary versus NASDAQ. I did the
Green light.
Kospi because that's kind of right now what you would think of ARK 5 years ago, basically. And then you have silver versus gold, which everyone knows because you saw silver way outperform gold, and now it's dumped. And the red line is the dollar. So you get this move down, down, down. Everybody's hating the dollar. Not surprisingly, silver to gold spikes right at the dollar low. NASDAQ to S&P spikes up there. And then since then, we've had a pretty steady dollar move. And you've seen these waves of deleveraging, right? So the silver and gold and NDX kind of speaking going down, had a little bit. But this Kospi, and when you're talking about this, spiked right before the war was the height. And since then, it's kind of treading water. But we're starting to see, I think the EWY is down maybe 15, 20% off the peak high. But there could be some more. There could be some more room there.
Yeah, no, without a doubt. Listen, this move in Treasury volatility has really been vicious. As we were talking about last week, it is costing real money. Money is costing real money right now, and this is the primary culprit for that.
Without question. And again, remember, the volatility is the price of money. When the price of money goes up, leverage comes down. But it all kind of sinks in. We're talking about deleveraging. When you have that spike in rates last Liberation Day, and you see that to the end of the year, that's vol suppression. Now you get reminded, vol rises, leverage drops, and then people have to sell the bonds because they're getting ran over. And remember, most people who trade rates, especially in the Sterland, it's big boy leverage, right? And so
absolutely,
you can't carry these positions because it's just a lot of it's mechanical. The risk management systems are mechanical, and the move is 20% 2-year, 20% 5-year, 40% 10-year, 20% 30-year, and something that sharp, it's gonna wreak havoc basically. And then there's the feedback loop of once you get the tap on the shoulder, then it accelerates it, and then another guy gets a tap on the shoulder until it's time it exhausts itself. So the real question is, when we look at all this vol, and let's go to the next one as well.
Yeah, gold's been extraordinary.
Look at that.
So this is the weekly chart of gold volatility since the GFC, right? And we are nudging into altitude levels around at least the early GFC here. Just an idea. I'm not sure if I'm ready to put it on yet, but would you sell basically one and a half month gold vol at 37? If he wanted to own more longer term, something to think about, right? This is a 43.50 put to May 26th expiry in the. I would prefer.
I don't know. I haven't looked at the skew on that right now. That would be interesting to look at. But I would rather sell puts lower, to be honest, because I do think there could be one more douche down in gold. Like I was looking at the chart, and I think 3,600 to 3,800 could be the range where the actual kind of we're stepping back in. That is. And just to be clear, Rupert, you remember we shorted gold for a trade when it first hit 4,400 in October, we got a quick 10% move on that.
I call it.
As in me and my contingent.
I call
and
it.
Not because again, not. Go ahead. Sorry.
Yeah, no, my collar kind of worked. It was a bit of a sort of nothing done in the end. I think what I'll do is I will put this is the futures options version. What I'll do is I'll put a GLD version of this idea in the show notes, right? And maybe, as you said, a bit lower down. I want to have a look at where that skew is. I just use the futures because it uses, GLD spot doesn't look like gold spot, and so I'm just using the futures options for illustration here.
But I do totally agree with this idea that, remember, volatility, as the price of money. When the price of money is high, that's when you want to when high yield blows out, that's a good time to buy high yield. When rates blow out to highs, it's a good time. So remember, this is way beyond the scope of this, but when you have high vol, it is an implied yield. So you can have an implied yield curve from volatility curve. And so, we're at the highest yield or the highest vol since the GFC. And so if you want to buy the dip on gold, you can lock in a pretty good yield. And if you get hit, and then you're just long lower. And I don't know. I mean, now, again, I wouldn't do it with leverage because you can get really...
This is really important, right? This is gold that you were going to buy anyway, right? If you felt that the world has changed, I'm at just over 6% gold allocation in my beta portfolio. I'd quite like to be closer to 8 or 9, right? And if I can get, if this is a way to get me back in, it sounds like a reasonable idea. I like you say, I think that there is this potential for another, piggy bank flush down as you talk about it. Anyway, let's get back and finish up on FX. Okay, this is a longer dated chart on FX vol, and what's interesting is that I was scratching my head last week, which was my one of my primary portfolio hedges is some 115 strike euro dollar puts, which and the euro was meaningfully lower over the week, and it's opened again lower this morning. But actually, the euro dollar vol eased off over the last couple of weeks, which was sort of okay. Granted, after a big spike, but that was an interesting observation for me. Anything else you want to say? I mean, obviously, dollar yen screaming higher in terms of vol.
Yeah, I mean, I think Korean won and Japan and Thai baht and any of these Asian energy dependent currencies, I think that they're in a bad spot, and you're seeing that the hedging market is reflecting that basically. And again, we're kind of at the level here where, although yen is wild. And remember, these are 25 deltas butterflies, so it's kind of a pure way of looking at vol basically. And
in isolation,
they kind of all steadied off in the last they ran up, and then now we've kind of been treading water for a couple of weeks, except for the yen. The yen has decided it's still on its way to heaven. And I don't know, we crossed 160, buddy. 175's next. But yeah, I don't have much else to say other than just like the S&P at the 300-day, just like credit spreads at, high yield at 400, just like that. Like a lot of this stuff is kind of at that break point where the next level, you're moving into a much different kind of market, basically. A much different. It's not
this is
stable.
just the same chart, and this is the same chart on a shorter time frame. Okay, you wanted to talk about memory quickly. I think
I talked
a big part of the Korea story.
Yeah, we talked about Korea. I don't remember, month or some point ago, and Rupert had highlighted how it's the most concentrated index there is, right? Like, what's the percentage total on that thing with the top two?
Samsung and Hynix are almost 50% of the EWI, right?
Right. So last week we get this,
and also the other 50% is part of that supply chain as well. It is a single bet.
Yeah. So, and as I think I've said it, regular listeners know I'm involved with this AI company called Second Brain AI. And our play is basically trying to build a memory graph to improve compression, which ultimately means you don't have to blow so many damn tokens and not, but in the meantime, all this DRAM is going through the roof because, it's very inefficient the way that these things are working right now. So you have this turbo quant out of Google come out, and it's been around for Google for a while, but they kind of published their research a week ago, and I noticed it. And I kind of started thinking like, maybe we should short the memory stocks now, because I think the average guy who's not like trying to pay attention to everything that's going on in the front line of AI, who's in the markets, it got made aware of. And then Thursday, I think almost the whole memory space was down 10% or something like that in a day. And Korea being a pure play on memory, plus the energy dependence, plus exports. and being the hottest market in the world, I have no financial advice, but I would just guide you to looking at Korea. If you're looking to short risk, that might be the better way to do it than just shorting the S&P. Is all I guess I would say.
Yeah, and a very leveraged equity market as well. You know, the Korean retail really show the world in terms of you know, how to YOLO. Okay. Switching topics. Did you want to talk about this? I mean, same story.
Oh yeah, you know, and just went back. Well, kind of what we've been saying the whole time. Just showing who really has the exposure here, right? Bloomberg put this out, and I thought it was worthwhile. You see China, but China's a big dog. They have, you know, they'll be the last one to really have a panic from it because they have stockpiles. Japan has stockpiles. They are all a little more sensitive on LNG versus, you know, I think oil's more of a stockpile thing. But India, as Rupert's hated since I met him and first time I ever had on my podcast, and then South Korea, you know, so these are your losers from the situation in essence. And so, you know, which market do you want to short? I mean, to me, China's kind of still been whatever. Japan, I kind of like. We had Squirrel's friend Mateen on here, and we kind of talked about it. So that's more of a buy the dip at some point thing. And South Korea is where I would just, or India, and you know, go back and read some of Rupert's research. He's written about it extensively.
Yeah, I mean, I basically I have an India short against basically all of my remaining EM longs right now, and you know, I'm very comfortable with that position, particularly while this is all going on. So Aussie ruggedization week. So listen, I put out a free note on Saturday on this topic, so do check it out at blindsquirrelmacro.com. It's called Time for Some Hard Yakka. So just going back to what we were talking about, this is a bit of an eye test, this chart, but the Augur Infinity chart in the middle at the top is owner occupied and investor housing finance approvals against the Aussie cash rate, right? And essentially the RBA gave property investors a green light to gear up on real estate, and then promptly hiked them 400 basis points just after doing that. Got an apology from a central banker, which is rare. But the reason being is that the supply shock around that kicked off around the time of COVID and then the Ukraine war created some major headaches from inflationary headaches for Australia. Really exposed a soft underbelly for the economy in terms of its exposure to sort of butterfly effects around the world. And I can't believe that 4 years later, this Iran war has triggered, you know, risk of fuel rationing, that we might not get our waste collected within a couple of weeks' time because the dumpster trucks are running out of diesel. And I went through, you know, why this has happened. I had made the mistake of thinking that 2020 to 2022 was going to be enough for Australia to wake up and realize that they needed to fix that, and had a go at Aussie dollar upside at the time, which spectacularly did not work. And really, the Aussie dollar, or as we affectionately call it, the Pacific peso, is only above the levels when I first arrived here 4 years ago in the last 90 days. And I'm afraid that's all for the wrong reasons, which is, you know, another commodity spike. What's amazing, Gerard Minack has a fantastic line about Aussie equities, US multiples for European growth. You know, only in February, and it sharply got reversed, obviously in March, did Australian equities in US dollars crest the levels that they last saw in, wait for it, November 2007, right?
Wow.
I mean, it's been a lost 2 decades. And
Can you go back
you know,
there for a second?
really,
Can I ask
yeah,
you a question, Rupert, before you go?
yeah, sure.
When you look at that, I mean, and we're talking about guys who are sensitive to the situation. I mean, is that a short?
Listen, there are a number of reasons why Aussie equities in Aussie dollar terms look absolutely fine. You know, we've got this massive superannuation scheme. You know, 4.5 trillion Aussie dollars and growing at 8% a year. There will always be that flow of pension savings that is keeping Commonwealth Bank at 4 times, near as damn it 4 times book, right? You know, one of the reasons I get asked by my readers a lot is, you know, why I don't write about Aussie equities much as well. The banks are at the top of the index, and that's, you know, and they're unbelievably expensive and obviously very exposed to a very inflated real estate market. Then you've got the Rios and you know, the big global miners, and frankly, I prefer Glencore as my exposure there. And then at the other end of the index, you've got some really racy resource stuff, you know, Vancouver style, and then anything sort of vaguely interesting in the middle of the market, you know, the occasional software business or other stuff or, you know, Australia's answer to Chipotle, which is called Guzman and Gomez, it gets bid up to this ridiculous valuation. So, I mean, and also apart from that, there are plenty of stock pundits in Australia. I just don't think they need another one in rodent form. But I did write about Aussie equities this weekend because I think there is a real existential need right now for Australia to grow the fuck up and ruggedize its economy. We only refine 20% of our refined product, of our diesel, gasoline, and jet fuel. We literally closed 6 of our 8 national oil refineries since 2003. And we're now, as you know, arguably the Saudi Arabia of agriculture, we're now in a situation where we import 95% of our fertilizer. You know, when there's more arable land per capita in Australia than any other country on the planet. It's wild madness. Anyway, that's a little bit of a PSA. There's a full note. Please read it for free at blindsquirrelmacro.com. Anything else you want to say, Benny?
You know, I think that, like, when you think about the ruggedization, you see some of the energy policy changes that came out of the 70s. And, you know, look at the chart of nuclear in Germany, right? They just decided to rip. And, you know, the U.S. went the other way, weirdly, because the U.S. was a nuclear leader. And then in 75 or something, they just like, no mas, well, stupidly.
It was 3 Mile Island, as Tom was saying.
Yeah, no, I get it. I understand. But I'm just saying, now Germany, they did this own goal and ironically wanted to go to war with the guys who provide them their gas when they turn on their own power off. And you're talking about all this with Australia. You just think that, like, Europe and some of these countries had this questionable policy on energy for a while, and you just wonder if the climate EV, you know, stuff that might just be over. You know, like, people are realizing energy is the most important thing in the world, and you need as much of it you can from whatever source you can.
Well, listen, it's not. Listen, I think you need every molecule of energy. So, you know, listen, wave in the solar, wave in the wind, provided it makes sense. And ruggedize your economy. You cannot rely on just-in-time supply chains anymore. You know, there's an IEA mandate that each country should hold 90 days worth of their refined product requirements. You know, we have storage here for 30 days, and we fudged the 90-day bit by counting the product in tankers on its way to us from Asia, which is you know, very cute, but incredibly fragile. And as we know, all it takes is a phone call to turn a ship around to a higher bidder. Anyway, listen, we've run over this week.
But let me just finish one last thing on that. I do think that the whole point is what Rupert was saying, is it's what, you know, Nassim Taleb talks about, Dredge talks about, in this idea that McKinsey consultants have convinced the world of just in time, and that like efficiency at the expense of robustness. And this is just another example of it. And, you know, you think about, why do you have savings? Well, for a rainy day. Well, you should have energy, which is primary money, for a rainy day as well. And it's just kind of the same thing we kind of harp on, which is the tails matter because they're low frequency, but they're high impact, basically.
And also, why do you have gold for a rainy day? That's why it's been selling off, guys. It's pretty rainy out there. Anyway,
yeah.
I forgot, who have we got on Thursday? We got Russell on Thursday.
I think Russell Clark on Thursday.
We got Russell Clark on Thursday. Really looking forward to that.
Yeah, that'll be fun. And I think he thinks rates are going to go higher, so we'll have a good little exchange on that.
We're going to have a great rate debate between you two. I shall referee. All right. Welcome back to LA, Benny. Benny and the squirrel out, I think.
I think so.